In this current low-rate environment, a lot of investors are looking to real estate investment trusts to get returns, but some people say that's created distortions in the market and opportunities for investors instead in real estate operating corporations, known as REOCs, especially in Western Canada. Jeff Olin is President and CEO of Vision Capital and runs the Vision Opportunity Funds. Great to have you with us.
Thanks for having me.
So let's start with the premise, first of all, around what's happening in the REIT market. Are REITs now overvalued? Is that the concern because people have been rushing to them looking for yield?
I think on average, REITs are currently fairly valued. They're trading roughly in line 1 or 2% of their underlying net asset value. Historically, they've traded at 4 to 6% premiums. The valuations are building in some expectation of increasing rates, perhaps not to 350, 400, 10-year U.S., but probably to around the 300 level.
Jeff, one of the concerns I have as an investor in this whole asset class, whether it's commercial, residential, condo, whatever, in a rising rate environment, which I think we're going to have over the next 4 to 5 years, this usually is an asset class that underperforms. And so a real estate operating corporation or company, is that going to act the same way as everything else in real estate as rates go up? In other words, underperform?
I think what you find historically is that while there is certainly an impact from rising rates, virtually 100% of the time, sometimes with a lag, supply and demand fundamentals trump interest rates, whether rates are going up or down. And today you have some protection because inherent in Amanda's question, you have real estate operating corporations, names like Morguard Corporation, Main Street Equities, which are trading at significant discounts to the underlying net asset value. And this is providing some cushion to rising rates. They're providing the upside and they're providing the cushion on the downside. The second thing is people forget that the simplified valuation equation for real estate has net operating income divided by a cap rate. Interest rates impact the cap rate. Everybody focuses on interest rates, cap rates, interest rate cap rates. They forget there's a numerator, net operating income. So if you can find companies that have net operating income organically, externally, that are growing, value add, that are growing more quickly than the impact of interest rates, that's helpful. And today, the weighted average cost of interest rates on average in the REITs is still above current rates. So even when they refinance, many of the REITs are going to have interest rate savings, even though rates are rising.
Can you describe the type of investor for whom a REIT or a REOC is appropriate? Is it almost anyone?
I think all investors should have somewhere between 10 to 20% of their portfolio investable assets in real estate to some degree. And certainly real estate's REITs and real estate operating corporations are a good place because nobody's going to call you in the middle of the night to fix the toilet.
Right.
And so they're liquid, they have professional management, corporate governance, transparency, you can get in, you get out, and so they're a relatively good place for the average investor to invest.
Jeff, let me probe your assumptions about increasing operating income. How is that possible if my REIT is full of long-term 5, 10, and 15-year leases, where I can't build anything more than inflation growth that I originally signed the leases on?
Now
how do I increase cash flow? Do I go and threaten my tenants with a gun?
Your point is valid, and so in this kind of environment, you can look at, we have a significant bias to rental residential. Those leases roll annually at the extreme. Hotels, not a great, we don't love hotels, but it's certainly an asset class. You get a new lease every day. So long-term leases, you're absolutely right. We see office space is a negative, not so much because of the long-term leases, which your point is very relevant, but because we have 7 million square feet of new development in Toronto and 5 million in Calgary. And so shorter leases can benefit to increase net operating income when there's positive supply and demand fundamentals that allow you to increase rates.
One part of the market is the rental market. Do you like that as an investment, so not the longer term leases, but the...
We like rental residential generally, and we like Western Canada particularly. You have 1% vacancy rates in Calgary and Edmonton. There's no rent controls. You're aware 90% of the jobs in Canada were in Alberta last year.
Yeah.
You have population immigration, migration, and then one of the names I mentioned, Main Street, is exclusively focused in Western Canada.
And so just 10 seconds here, but in terms of timing, does it matter when you get in? And we do talk a lot about rates going up and the effect it has. Would you say these are long-term plays regardless?
The names I mentioned, they're trading at discounts to net asset value, and rates can go up or rates can go down. The fundamentals are solid.
All right, Jeff, great to have you with us.
Thanks for having me.
Jeff Olin, President and CEO of Vision Capital.